Every year, the average American investor writes a check to the IRS for $1,500 to $3,000 they didn't have to pay and never realizes it. The strategy that would have stopped it is perfectly legal, takes under an hour to set up, and has a name most people have never Googled: tax loss harvesting. I want to be upfront with you. Tax loss harvesting gets oversimplified by finance influencers into free money advice. It is not free money. It is not a loophole. And for a lot of people, it might not even be worth doing. But for anyone with a taxable brokerage account and a portfolio over about $50,000, ignoring this is leaving real dollars on the table. Let's break it down, number by number, with the skepticism it deserves. Here are 6 things you actually need to understand before you touch it. Point 1. What tax loss harvesting actually is and what it is not. Tax loss harvesting means selling an investment that has declined in value to realize a capital loss, then using that loss to offset capital gains you've earned elsewhere. If you sell a stock and made $5,000 profit, that's a taxable gain. But if you also have a position sitting at a $3,000 loss, sell that too, and suddenly you're only taxed on $2,000 instead of $5,000. If your losses exceed your gains, you can deduct up to $3,000 against ordinary income, your salary, your freelance income, whatever you earn. Any losses beyond that carry forward to future tax years, indefinitely. What it is not a way to avoid taxes forever. It is a deferral strategy. You are pushing your tax bill into the future, not eliminating it. Anyone who tells you otherwise is either confused or selling something. Point 2. The wash sale rule is the trap most people fall into. Here's where it gets critical, and where most people blow it. After you sell an investment at a loss, you cannot buy back the same or substantially identical investment within 30 days before or after the sale. This is the wash sale rule, and violating it disallows the loss entirely. Sell a Vanguard S&P 500 ETF at a loss and rebuy it the next day. Loss disallowed. The IRS has seen this play before. The tricky part is, substantially identical isn't perfectly defined. Selling VOO and buying SPY, both track the S&P 500, is a gray area many tax professionals consider a wash sale. Selling VOO and buying a total market ETF like VTI is generally considered safe, but even that isn't guaranteed. This is exactly why I'd be cautious about any robo-advisor promising automated tax loss harvesting without you understanding the wash sale implications yourself. The automation handles the math. The IRS audit is yours to deal with. Point 3. The numbers only work if you're in the right tax bracket on this. Here's what surprised me when I actually was in capital gains and $8,000 in harvestable losses. You're in the 22% ordinary income bracket and the 15% long-term capital gains bracket. Without harvesting, you owe 15% on $10,000. That's $1,500. With harvesting, offset $8,000, owe 15% on $2,000. That's $300. Net savings this year, $1,200. But, and this is where people stop listening, you've now lowered the cost basis on your replacement investment. When you eventually sell it, your taxable gain will be larger. You have not erased the tax. You have deferred it. The math works in your favor if your tax rate stays the same or drops in retirement. It works against you if you expect to be in a higher bracket later. Run the numbers for your specific situation. Don't just harvest because a podcast told you to. Point 4. It matters more in high volatility years, and 2022 was a masterclass in missed opportunity. In 2022, the S&P 500 dropped roughly 18%. Bond markets had their worst year in decades. Virtually every asset class fell. That was one of the greatest tax loss harvesting opportunities in a generation. And most retail investors either panicked and sold everything outright or froze and did nothing. A Vanguard study estimated that systematic tax loss harvesting can add between 0.5 and 1.5% in after-tax returns annually for taxable accounts. In a down year like 2022, that figure was likely even higher for investors who were paying attention. Here's what most people miss. This strategy is most valuable when markets are falling, which is exactly when it feels emotionally impossible to act rationally. If you only harvest losses when you feel good about the market, you're doing it backwards. Point 5. Tax loss harvesting is almost irrelevant in retirement accounts. This trips up a lot of people. If your investments are in a 401k, traditional IRA, or Roth IRA, tax loss harvesting does nothing for you. These accounts are already tax advantaged. Losses inside them don't reduce your taxable income. They just disappear. Tax loss harvesting only applies to taxable brokerage accounts, the ones where you invest with after-tax dollars and get a 1099 every year. If the bulk of your investments are in retirement accounts, which is the right call for most people, this strategy has limited or zero relevance to your situation. It's a tool for a specific phase of wealth building, not a universal trick. Point 6. The administrative burden is real, and nobody tells you this up front. I went through this manually in 2021, harvested losses across 4 positions, bought replacement securities, tracked cost basis adjustments, and handed my accountant a spreadsheet that looked like a biology experiment. His fee went up $200 that year. My total tax savings were $340. Net benefit after accounting for his time, $140 and about 4 hours of my own. For investors using tax software and a simple 2 ETF portfolio, the overhead is manageable. For anyone with individual stocks, options, or multiple brokers, model it out before you commit. The bookkeeping cost in time or money can easily eat the benefit. If your brokerage tracks cost basis automatically and you're harvesting in straightforward index funds, the friction is low. Otherwise, price the labor before you start. Point 7. When it actually makes sense. A clear decision framework. Here's the honest summary. Tax loss harvesting is worth pursuing when you have a taxable brokerage account, you have realized or unrealized gains to offset, or want the $3,000 annual income deduction, you're in the 15% capital gains bracket or higher. You have a suitable replacement security that avoids the wash sale rule, and the administrative overhead doesn't exceed your projected savings. All 5 true? It's a legitimate, evidence-backed strategy to reduce your current year tax bill and improve after-tax returns over time. One of them off? Skip it this year. The strategy will still be there. Closing. Here's exactly what to do today. Open your taxable brokerage account, filter your positions for unrealized losses, and flag any holding that's down more than 10%, where you could swap in a similar but not identical fund without triggering the wash sale rule. Then, pull up your realized gains for the year. Most brokerages show this under tax documents or gain-loss summary. If the offset math works and you're outside the 30-day window on that position, bring the numbers to your accountant before December 31st. That deadline is the one that matters. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making financial decisions, especially on anything involving the IRS. Tax loss harvesting is not a secret the wealthy are hiding from you. It is a documented, legal, and genuinely useful technique, but only in the right accounts, only when the math actually checks out, and only when you understand exactly what you're deferring and why. Don't harvest losses because it sounds smart. Harvest them because you've done the calculation. If this breakdown was useful, subscribe. I do evidence-first financial analysis every week. And drop a comment. Have you ever done tax loss harvesting? Did it actually save you money? I want to see what the real-world numbers look like.